Hey guys, this is Mr. Roxy coming at you live from Palm Beach. It is Friday. It is July the 29th. July is in the books. It is finished. I actually expected a bit of a pullback on the market today because usually sort of in the last couple of trading days of the month, traders start taking a bit of profit and we usually see a little bit of a dip, but not today. It went up. So I guess we're all happy about that one, right? If you're in energy, you probably had a great week and I hope things are going well for you and your portfolio is looking good. What I've decided to do with this meeting here is I'm going to share with you a presentation that I made, and I'm kind of referring to this as Bidenomics because it relates to energy. And at the same time, what I want to do is talk a little bit about the macro environment that we're currently operating in. So to kick it off with, we saw some super majors reporting this week, one of them yesterday and a couple of them today and so on. Exxon, Chevron, Shell all recorded record profits based on high energy prices, and collectively they posted $46 billion in combined profit for the latest quarter as they cashed in on rebounding energy demand. A fantastic quarter for the super majors. So let's see what else is going on. In addition to these, shares of energy companies are trading higher amid a rise in oil prices ahead of next week's OPEC meeting. So we have an OPEC plus meeting coming up next week. More about that one in just a second. Strong quarterly earnings from Exxon, Petrobras, and Chevron. So here I've taken away the reference on the previous slide to Shell and added Petrobras. But let's just look at the EPS compared to the expectation. Chevron came in at $5.82 versus an analyst expectation of $5.08. Exxon $4.21, expectation $3.78. Royal Dutch Shell came in at $3.08. The expectation was $2.80. Petrobras just completely killed it this last quarter. $1.68 in American dollars versus the expectation of 93 cents. So what happens next week? Because we got Oxy coming up on August the 4th, and then the conference call following the earnings release. Oxy earnings expected around $3. I think we'll probably just top $3. On revenue of about $10 billion for the quarter. Whatever the final numbers look like, it should be a really good quarter. So the thing here with Oxy, which obviously is applicable to all the super majors as well, which have just reported, is that as much as they are benefiting from the higher prices of crude, they also are struggling based on the higher costs. And in addition to that, they also have to struggle with resourcing because what's happened over the past couple of years since the COVID pandemic, which started obviously in 2020, a lot of highly skilled people left the industry, and that left quite a gap in terms of their human resources. So in addition to paying more for stuff, they also are struggling to attract and retain highly skilled, talented people. The EPS trend, so earnings per share trend for the quarter, as I said, is about $3, but then for the current year, approximately $11 per share. Pretty good, considering especially where we came from before. Taking a quick look at the snapshot here. So Occidental has really become sort of a more typical value stock, except for the fact that it doesn't pay a very rich dividend. You can buy Oxy at $65. You still arguably can pick up some Occidental relatively cheap. It's got a PE of less than 10 that indicates to us that based on the current price, the price earnings ratio is showing us less than 10 is slightly cheap. So if you want to add a bit to your existing position, you could probably do that, and it's okay. Don't be surprised if Oxy adds significantly to the existing dividend yield, and we'll see where that goes and what happens. And then, as I mentioned at the start of this particular slide here, down here at the bottom in the middle, held by institutions, 81%. Thanks also, of course, to Uncle Warren Buffett. But Oxy has kind of become more of a Me Too stock than a growth stock. So we don't expect Oxy to necessarily go from $60 to $120 very quickly or very rapidly, unless Berkshire Hathaway puts in a bid to buy the entire company, perhaps. But you can expect a bit of an uptick here. I certainly think Occidental right now is a maybe $75 stock instead of a $65 stock. 2 months ago, I made a video and I said why I am buying Petrobras. I took a little bit of heat for that. Of course, some people wanted to educate me, quite rightfully so, because I'm open to being educated about the political situation in Brazil, the level of corruption, the way in which the politicians get their hands into the cookie jar as it relates to Petrobras and other large sort of state-controlled organizations. Anyway, my thesis turned out to be kind of okay. If you have a position in Petrobras as well, I'd like to kind of get your thoughts on this. Now, talking about that just for a second here, I do want to talk just very briefly about the concept of risk mitigation, right? So you get a run up on a stock, if you guys were with me 2 years ago and we were buying Oxy for, 10, 12 bucks or whatever, you've got more than a 400% gain right now in terms of the price being at about $60. So you need to make that decision. And ultimately, I said just earlier today when I was chatting with Michael Boger from Germany via Telegram, I said, the best thing that you have in your favor is logic and common sense and patience. But the worst thing, which is your enemy, is greed, right? So you need to take a little bit of profit if you get the opportunity to do so. And maybe now is a good time to take a little bit of profit. If you think that's what you should be doing, just take a little bit of cash off the table. I've also covered in previous videos, so if you go into my library, you'll get some old stuff here from when I was really young, right? So December 2020, December 2020, September 2020, I talked a little bit about a trailing stop. Now, trailing stop is almost like a covered call, but it's a little different. I like trailing stops. I don't use it too frequently, but I do use it from time to time. What happens with a trailing stop is that when you plug in a trailing stop, so let's say, for instance, using my example of Occidental, you're up 400%. So you can say, I'm going to plug in a trailing stop of 20%. So if Occidental pulls back 20%, so 20% of 400, 20% of $60 would be about 10 or 12 bucks or so. If it pulls back $10, I'm just going to exit automatically, take my profit, and find another Occidental Petroleum. That's the sell part of the stop loss order, which is a trailing stop. If your brokerage online system provides you with trailing stop functionality, it's really cool to use as a tool to mitigate risk, because it's called a trailing stop because the stop loss order that you plug in, so let's say 10%, will trail the stock. So if it goes higher, it can go to the moon and nothing happens. The trailing stop just kind of tags along. Nothing happens. But as soon as it pulls back, using my example, like 10% or 20% or something like that, it executes and becomes a sell order and just closes your position. You exit it automatically. And if you want to learn more about trailing stops, you can look back in the library and you find some of these. I think this middle one here, part 1, trade Oxy profitably with trailing stops, December 1, 2020, might be the better one of the three. The other one is really old, and this one I used a little blackboard to kind of explain sort of how trailing stop works and what it does. Let's take a quick look here at Petrobras, and then I'm going to show you another risk mitigation strategy that you can deploy when the market is as volatile as it currently is. You can buy Petrobras for 14 bucks, even though it's kind of close to its all-time high. The PE ratio on Petrobras is 3. So when you have a PE ratio, a price to earnings ratio of 3, that is not necessarily cheap. That is almost free. So Petrobras is super cheap, and it pays a dividend of over $4. And a stock that pays a dividend of over $4 on a stock price of $14 is currently yielding almost 30%. So Petrobras is an interesting one, but there is huge risk here. And of course, there's volatility as well, because remember, we're going into the October election where President Bolsonaro is hoping to get reelected. And he's sort of viewed by many people as the far right winger, who hates women, hates gay people, all that kind of stuff. It sounds sort of like Trump. And then on the other side, the flip side of the coin, sort of bookends, you have Lula, who's the far left, radical left winger, so there's no one in the middle. You're either going to go with Bolsonaro or you're going to go with Lula, one of the two, right? So anyway, that is some risk, and that's coming up in October. So you need to trade carefully here. And if you have a gain on Petrobras, you might want to make sure that you protect that gain. A little bit of upside here as well on its 52-week high, $16.30. It's currently trading at $14. You can buy Petrobras, which is PBR, but you could also buy Petrobras Prefers, PBR.A. And you can hold either one of those. They both pay a big fat dividend. There's not a lot of difference between the two. Yahoo Finance reported that Petrobras shares jumped more than 6% on Friday. That was today. hitting a 12-year high after the state-run oil company smashed quarterly profit estimates and announced a record dividend payment yesterday. It was Thursday. The company announced on Thursday afternoon an 87.8 billion real, which is 17 billion US dollars, dividend payout, its largest ever, and a dividend payout of 6.73 real per ordinary and preferred or preference shares. Now, just for the sake of people who are watching this from an international point of view, 6.7 reals is approximately $1.30, which I put up in the middle of the screen there at the top. So it's $1.30 for every share of Petrobras that you hold. You will earn a $1.30 dividend in US dollars. Why? The street has been wooed by the generous dividend policy, solid profits, and high demand for the company's products given the supply crunch, which is still where we are right now. So we see demand kind of gradually edging up higher and higher and higher, and the supply is kind of more or less static or stuck. We're not seeing a lot of extra product coming into the market. Also, from a risk mitigation point of view, and here I speak from a personal point of view as well, is XLE. XLE is an ETF. It's an energy ETF. As you can see on the right-hand side here, I've listed the top 10 holdings in XLE. So if you are nervous or afraid of taking a single stock risk and buying something like, Occidental, Devon, Energy, Petrobras, etc., with all kinds of things happening, Occidental is going up and down, and Petrobras is an election coming up in Brazil in October, things like that. If you are concerned about the single stock risk, then what you can do is you can certainly buy into XLE and actually just own the entire energy sector. And as we know now from my experience already, the energy sector right now is the place where you want to be. And look at the holdings on this. Almost half of XLE is Exxon and Chevron. You can't go too wrong there. And the next three together, Conoco, EOG Resources, and Occidental Petroleum, is another 12, right? So when you look at this ETF, you got 43 and another 12, so 55, more than half of XLE's holdings is in these 5 companies: Exxon, Chevron, ConocoPhillips, EOG Resources, and Occidental Petroleum. And then you get a slight drop off, but these are really great companies, and most of them pay a really good dividend too. And that's why XLE pays a dividend of almost 4% as well. If you're buying a fund, any kind of fund, you don't want to buy a mutual fund because mutual fund has nosebleed fees, right? But you can buy an ETF because you can see the gross and net expense ratio here is just 0.1%. Most people who manage money for other people are charging 1% on assets under management plus a percentage on the profit. In the good old days, in the good old Wall Street days, from a couple of decades ago, perhaps before 2008, that number used to be 2 and 20. So people charge 2% to manage your money and 20% of your profits. That later became sort of 1 and 10, 1% of your assets under management and 10% of your profits. Today, it's a little bit more mixed. Some of the financial managers are charging 1.5%, and they take a small scoop of the profits. Anyway, you can buy XLE and pay the expense ratio of just 0.1%, and you can currently buy it for just under $80. Not a bad deal. It's high. It's 52-week high. It's $93.31. So I want to take just a couple of minutes here, then I'm going to wrap it up, but I do want to talk a little bit about the macro, right? So the VIX over the past month is down almost 24%. The VIX is the volatility index, or better named as the fear index of the Chicago Board of Exchange. So the index at the top here, CBOE, Chicago Board of Exchange. The volatility index shows you how concerned people are about where the market is headed and where it's going. So currently, it is sort of on a decline, even though it obviously, much like the market, ebbs and flows. We do see on the left-hand side here, despite President Biden's best efforts to control the oil price, we're back at about $100 a barrel on crude. That's for WTI and Brent, which means the energy companies are literally still printing money hand over fist. So what happened when our fearless leader, President Biden, traveled to Saudi Arabia? So not a lot. But what did OPEC do since? The Saudi officials say any decision to pump more oil will be taken within the framework of OPEC+. That means they will not be influenced in any way whatsoever by what your fearless leader and mine has asked them or begged them to do in terms of producing more oil. It's not going to work because OPEC is in the business of making money, and the higher the oil price is, the more money they make. Prince Faisal bin Farhan told reporters that we will listen to our partners and friends from all over the world, especially the consuming countries, but in the end, OPEC Plus will follow market conditions and provide energy as needed. He pointed out, now there is an overriding philosophy and belief in the energy market amongst the people who follow the energy market, which includes yours truly, that OPEC cannot really produce much more even if they wanted to. In the same way the US producers cannot just turn on the tap and produce more oil, OPEC is in a similar position, give or take a few different countries where they perhaps have more or otherwise have the ability to turn on the spigot sooner. The OPEC Plus alliance, of course, also includes Russia, which is something that President Biden conveniently seems to forget from time to time. However, Riyadh was clear about its commitment to working within the coalition, regardless of the fact that the United States is trying to impose sanctions against Russia. Where is that Russian oil going? We'll talk about that in just a second. Saudi Arabia will boost oil production only in the case of a supply shortage in the market. Right now, we have a bit of a supply crunch, but there isn't really a supply shortage. Well, arguably there's a supply shortage because the demand is greater than the supply, but it's not really a situation where OPEC would want to release more oil into the market that will lower the price significantly because they're in the business of making money. Officials also play down the idea of any agreement with the United States about an increase in oil output. It is not, this is a quote, about the agreement, but about the kingdom's long-term policy of working to ensure that there is sufficient supply of crude oil in the markets, and we are following the supply and demand condition very carefully. If there is a potential shortage, we are working to increase crude oil production, and that will be made in coordination, that decision, with members of the OPEC and OPEC Plus group, regardless of what your fearless leader asks them to do. The Institute for Energy Research says hundreds of executive orders, regulations, and laws that have impeded oil and gas production and raised prices at the pump. These include killing pipelines, expanding EPA regulations on oil and gas drilling and refining, taking hundreds of thousands of acres of prime oil and gas lands, which are federal properties, off limits for drilling, etc. Currently, I think in terms of my last investigation, there were something like 6,500 permits that were held up by either the administration or the EPA, the Environmental Protection Agency, which is a bit of an oxymoron. There's no such thing. Anyway, 6,500 permits have been held up, which they will not release. And then at the same time, they complain that the US producers are not producing enough oil and gas, which is gouging consumers. Economist Casey Mulligan from the University of Chicago estimates that these policies have reduced oil and gas drilling by 2 to 3 million barrels per day, and that increased production would actually bring gas prices down at the pump, which President Biden would very much like, because otherwise the Democrats are going to get crushed in the midterms that are coming up soon in just a few months from now. To wrap it up with here, what's happening to all the Russian oil? So India and Asian nations are a vital source of oil revenues for Moscow, despite strong pressure from the United States not to increase their purchases. Why would they not increase their purchases? Just because the United States asked them to? Unfortunately for the United States, the population of 1.5 billion or so in India and over 1 billion people in China, that's almost half the world's population, need energy, and they are burning coal. And if Russia gives them cheap oil, they will buy it. Sales to these countries are boosting Russian export revenues at a time when Washington and its allies are trying to limit financial flows supporting Moscow's war effort. Now note, I'm not making an opinion here. I'm not sharing an opinion about the war. I don't have an opinion. I don't have any standing in this regard. I'm not a warmonger. Neither am I a war follower. Neither do I support Russia. Neither do I support the Ukraine. And neither do I support the United States administration. So I am simply stating fact. India has purchased nearly 60 million barrels of Russian oil in 2022 up to June, compared with 12 million barrels for all of 2021. So far, for a half a year, for 6 months, they have purchased more than 5 times more Russian oil than what they purchased for the entire 2021. And China bought $7.5 billion worth of Russian energy products just in May alone, in 1 month. I'm going to leave you with this. This is my little cartoon to end the video with. I'm riding with Biden. And anyway, this is kind of where we're at right now. I did want to give you a bit of an overview. Obviously, as you know by now, I am invested in energy, and quite heavily so, including in Occidental, and the newer one of the two is Petrobras. Other large positions I hold include Energy Transfer. That particular equity has also been good to me. And two others that I hold primarily because I'm collecting dividends is Enbridge, which is a Canadian company, integrated pipelines, energy production, natural gas utility in Ontario, in the province of Ontario. They're the gas supplier for heating and cooling. And the other one that I hold, which is also a pipeline, is Pembina out of Canada as well. It's a company with many thousands of miles of pipelines, and they've all been really good to me during this period of volatility that we've gone through. In fact, I'd go as far as to say, if it weren't for the energy equities that I hold, my portfolio would have been like, meh, So on the other sort of larger side of the ledger, I have financial stocks. They've all pulled back significantly. Sometimes I get things right, and sometimes I get things wrong, pretty much like anybody else. But if you've been with me in Oxy for the past 2 years, enjoy those gains, whether they're on warrants or on common stock, and best of success to you going forward. This is Mr. Oxy signing off for now. Talk to you soon. Bye.